Good afternoon, ladies and gentlemen. My name is Brian Butchart, and welcome to our Global Investment Webinar. In May this year, Brenthurst celebrates its 20th anniversary, and I'm grateful to have been part of this journey from the start. In that time, Brenthurst has featured in the last 7 consecutive years amongst the leading wealth managers in Crutham, previously Intellidex, Top Private Banks and Wealth Managers Awards, and crowned the winners in 2017 and 2020. Over the period, several Brenthurst advisors featured as top relationship managers in the country. For the first time in 2022, all 3 of the top relationship managers were from one company, Brenthurst. And earlier this year, Brenthurst was voted the leading boutique wealth manager as reflected by a recent survey by well-respected business and financial news website, Daily Investor. Although we are humbled by the recognition, what's more important is the endorsement from our clients based on long-term relationships built on trust and service delivery. But most importantly, to deliver what our clients pay us for, to find the most appropriate investment opportunities and solutions for them and their families. Our key objective is to treat and achieve the results for our clients that we expect for ourselves. Brenthurst is founder-managed, privately owned, and not dictated to by a larger corporate focused on flows. We spend a significant amount of time conducting our own research and consulting externally to a number of financial professionals to develop our investment strategy for full autonomy and flexibility. And our clients value this independence. While asset managers have defended their local funds and continue to do so, recently, perhaps over the last few years, we've noticed the industry offering more offshore solutions. Coronation recently admitted it's been a decade of lost growth in US dollar terms regarding the performance of the JSE All-Share Index, and Alan Gray's CEO, Duncan Artis, confirmed that the JSE has shown no growth in US terms since 2006. For more than a decade, Brenthurst has advised a higher offshore exposure to their clients, a meaningful period to assess performance. Individuals who took the advice to externalize part or all of their assets are extremely grateful and have done exceptionally well when compared to those who remained local. The JSE All-Share Index delivered a dismal cumulative return of 26% over 10 years in US dollars, or an annualized return of 2.34%, compared to the offshore indices delivering strong double-digit annualized US dollar returns. The returns to the left of the graph are cumulative and right of the graph annualized over 10 years. Similarly, the RAND returns of the JSE All-Share Index have not stacked up against offshore returns over the last decade. Initially, our advice was to gain access to investment opportunities not available in South Africa. The technology sector is just one example, which has been the best performing sector over the past 10 years, albeit more volatile than the more diversified indices. And over the last decade, we became concerned about the mismanagement of the South African economy and the flow of foreign capital out of South Africa, thereby increasing our clients' offshore allocation further. Over the past 5 years alone, there has been a combined net outflow of more than 1.6 trillion rand from our bond and equity markets by foreign investors. Let me repeat, 1.6 trillion rand. That's a massive number. And if foreigners are fleeing our market, why would we advise our clients to buy? This, in our opinion, is a confidence indicator, and the results are clear. We've had numerous downgrades by ratings agencies. We've been grey listed, and the IMF earlier this year downgraded South Africa's growth forecast to 1% on the back of the impact of rolling power cuts and bottlenecks as ports and railways. The JSE All-Share Index has shrunk from approximately 800 quality listed businesses in 2001, now down to less than 300 as larger corporates have delisted, opting for far more attractive investment destinations with far less risk or red tape. A shrinking JSE All-Share Index translates into far less attractive investment opportunities. The RAND has also declined by about 7% per annum against the US dollar over the past 15 years, and hence the compelling reasons to invest offshore. Investors who followed our advice the last decade have fared far better than those that stuck to the local market. One of the funds Brenthurst has been suggesting for the last decade is the IP Global Opportunity Fund, managed by Tony Bell on behalf of our clients. The fund is 10 years old this month, has been a consistent performer, and achieved a 15% annualized return since inception. Tony also manages the Global Macro US Dollar Fund on Brenthurst's behalf, launched just over a year ago. Tony has 38 years experience. Having served 20 years as CIO, Tony established ThinkCell in 2023 to build the next generation asset manager. He has been awarded 10 consecutive Raging Bulls, a phenomenal achievement and an industry first. One of those Raging Bulls is for the IP Global Opportunity Fund he manages for Brenthurst. A newer addition to our investment solutions, perhaps for the last 3 years, are global share portfolios. Brenthurst, in collaboration with DFM Global, now offers global share portfolios with a focus on finding the top global stocks for long-term global growth. JSC is the MD and for DFM Global and has been in the industry since 1998. His journey began in derivatives, transitioning smoothly to asset management. He owned a controlling interest in the ShareNet Group and in 2019 orchestrated the management buyout of the unit trust and managed product division, shaping it into DFM Global today. JSC's experience and knowledge in product construction and asset management enhances our global offering and investment solution to clients. We are excited to have both Tony and JC on the panel today to discuss their views as part of creating a truly global investment portfolio. Finally, before I hand over to Tony, we are excited to announce the recent opening of our George office in the last quarter of 2023 to service our growing client base, living or semigrating to the Garden Route and Western Cape. Ladies and gentlemen, please welcome Tony, followed by JC, and in closing, our investment strategist who needs no introduction, Magnus Heystek. Tony, over to you.
Thank you, Brian. Just getting everything set up, and apologies for that. Can you see my screen?
Not yet, Tony.
Not yet. Okay, should be coming up in a second. Let's just get everything up and running here. So just a little bit of technical difficulty in the switchover. I'm just calling Zoom back up again. Share screen, right. Okay, there we go. There. We should be up and running into full screen
we can see
now. Okay. And we should be good to go. Perfect. Brian, can you see that?
Yeah, we can see you.
Cool.
That we can see the screen.
Ladies and gentlemen, thank you very much for your time and good afternoon. I'm going to take the next 10-15 minutes just to give you a very brief update on the performance of the fund that we've had the pleasure of running since it started 10 years ago. And then I'm going to share with you very briefly in 3 slides how we approach and how we think about building a global portfolio. And then a few slides on why we see a very different macroeconomic environment unfolding and how we've positioned for it. If we look at the performance of the Global IP Opportunity Fund, it's pleasingly done very well. In the chart, you will see a schematic of the performance of the fund since inception. And in the table, you'll see a table of the performance over different periods. Very pleasingly, first quartile, first, second, or third position over almost all measurement periods. But what I like most about the slide is the relative consistency. Bearing in mind this is an equity-oriented fund, 85% MSCI benchmark, 10% dollars and 5% cash. So the equity component is quite structurally high in the portfolio. Brian mentioned the Dollar Global Fund that was launched in March 2023. I contrasted here with the Dollar Global Macro is in red, and the South African Global Macro, the sister fund to IP Opportunity, converted into dollars, is in green. So a very nice start relative to the sector, adding good alpha. Brian mentioned the Raging Bull Awards. We're very pleased with them. Again, demonstrating consistency of return to the clients who invest in this. How do we go about thinking about global stock picking? I think where we deviate a little bit from the market is we're not entirely valuation driven. I came across the first edition of Michael Mabusin's book in 2002, and it triggered some interest. What Mabusin essentially says is that stock prices contain information. That information essentially is linked to its estimate of the implied growth rate of a company, and every change in the stock price changes the market's estimate of what the potential growth rate of a company could be into the future. And I took that as a lead in. Instead of trying to forecast earnings like everybody else does, we use a lot of inference to interpret what the market's assessment is and estimate is of a company and its expectations of that company. And very importantly, the second point in Mabusin's work is you will earn superior returns only if you correctly anticipate revisions in those price implied expectations. In other words, a large part of the known information is in the market. It's very difficult to get the edge. The market's like a big data cube, and the extent to which the market reassesses new information, it will change its expectations of the growth rate of a company. And so we use that to develop our own approach. That approach has been fairly consistent over many years. To put it into a simple picture, a study way back when by Nichols and Wallen showed a very simple outcome. Companies with positive earnings change and positive change in cash flow do far better than companies with negative changes in either earnings or cash flow. It's not more complicated than that. But to be able to analyze that a priori, in other words, ahead of time, that takes a little bit more doing. How do we do it? For those of you who are interested in procuring a copy of the book, freely available on Amazon, I believe it's going into reprint, almost sold out. We've just conveniently linked the pages. So we're very traditional in the sense that once we have worked out what we want to look at, this is how we look at it. And these things haven't changed. These are the factors that we put together in our assessment of every company in order to work out how the earnings growth vector could change over time. Leave that to you to read at your leisure. What's taking place in the macro view at the moment? And when we started 2024, the consensus was that inflation in the US would slow, growth would slow, the Fed would pivot quite quickly, it would underpin growth, and as inflation slowed, the reduction in interest rates would support earnings and the market would do reasonably well. The bond market would fall to a handle of around 3+ something on the US 10-year. And just as was the case with the start of 2023, that picture has unwound somewhat. Rates are now expected to stay flatter for longer. Why is that? That is because inflation is starting to tick up. The capital investment cycle in the US has been strong. Capital has flowed into the US, creating a very strong dollar. Earnings have been robust. Companies have managed their income statements well. Margins have expanded. And so the underlying position is not one of disinflation where the Fed is easily positioned to cut rates. Our contention would be that the Fed may even at the outset have to consider a small set of rate hikes if inflation were to become a little bit more stubborn or the momentum didn't slow much beyond this point. So what you see in front of you is the 5- and 10-year inflation break-evens, not ticking up to alarming levels, but ticking up reasonably meaningfully. Why is the Fed unlikely to cut anytime soon? The schematic over here looks at unemployment rate on the horizontal and CPI, and there's a very simple takeout. The Fed knows that when the economy is reasonably at full capacity and the unemployment or the jobs market is strong, to cut would just simply create second-round inflation. So it looks at history and says that's not a good idea, and we don't think it's going to be any different this time. What's our major concern for 2024? As we'll show you in the portfolio positioning in a few slides' time, we have cut a lot of our risk positions, and we're cutting primarily because we're concerned about liquidity conditions tightening. The chart in front of you shows real M2 money supply in the US. It's gone negative. And what we think the bigger risk is not a recession risk as shown in the highlighted areas, but potentially a liquidity-driven event. I've been in markets since 1987. It is an awfully long time. I've been through a number of stock market declines, 92, 94, 98, 2008. They were all driven by liquidity events. And so the one thing we look at from a risk management perspective is not only the fundamentals driven by the economic cycle and earnings growth, but also the financial conditions environment driven by liquidity. And at the moment, the aggregate liquidity conditions are tightening. Bond yields are going higher in response to higher inflation. Money supply is tighter, as shown on the graph in front of you. And the excess reserves available to the financial market system through this opaque thing called the reverse repo account at the New York Fed is tightening up. So the reverse repo essentially was an account where banks placed all of their excess reserves at the time of the COVID stimulus packages. Those excess reserves got to 2.25 trillion. They have been used up by, among others, Janet Yellen, topping up the general treasury account. But they've also been used by hedge funds to engage in this interesting thing called a treasury basis trade. Hedge fund borrows from a bank. It takes that money, it buys bonds, and it sells forwards on those bonds to institutions who want to be long bonds. If the Fed were even to think about raising interest rates, that treasury basis trade would become a very difficult continuation, and the hedge funds would have to unwind. So we're a little concerned. Yes, the Fed does have various other programs in place, but the general insight that we have is liquidity conditions are tightening. Where does that leave us in terms of the markets? Two charts courtesy of Alpine Macro recently published shows that both the NASDAQ and S&P 500 in reasonably extended territory. We always are very cautious just to look at the aggregate numbers. So we want to look at a little bit more of a granular level. And what we've done here is we've examined the relationship between the US 2-year Treasury yield and the S&P 500 earnings yield. So the earnings yield itself is the inverse of the price earnings multiple. And what we see is two patterns. We see a pattern which includes the very high levels of stimulus post-2008. And then, if you like, at the top line, the top regression line, a more normalized set of regression relationships. And in that context, the current level of the S&P 500 doesn't look untoward. But when you break it down, there is a very high level of segmentation between the top 10, top 7, top 5, whatever number you want to pick, and those like JP Morgan and energy stocks, which are way off the scale. And what that suggests to us is that we've had a series of cyclical rotations. Netflix hit a top, and then Alphabet hit a top, and Apple hit a top. And we've had this series of rolling tops. We now think that those rolling tops are feeding through into NVIDIA and Eli Lilly and Novo Nordisk. And for that reason, from a pure valuation consideration, we have taken quite significant risk off the table. So in terms of the last slide, how are we positioned? You'll see a couple of features from the Global IP Opportunity Fund. We have quite a conservative positioning in equities. That 75 is normally north of 85. In the last week and a bit, we've taken a position off Nvidia, quite a strong position. We were running at about 6.5%, 7% in Nvidia, hence the reason for the fund's very good return. You can see high quality positioning in the portfolio with the first entrant into a bond fund and some Japanese exposure to diversify geographically. From a sector perspective, you can see that the fund itself has trimmed its technology position. That at the start of last year was 6% overweight. We've brought that down to nearly neutral. And we're going into an environment where we are far more defensively positioned. What we're examining at the moment is the cyclical components of the portfolio and whether we need to bring some of these deep underweight positions more neutral. But for now, we think we've got a very good balance between high growth stocks, which is the primary focus of this fund, a very healthy cash position, and some good exposure to bonds to diversify the risk in the portfolio. Brian, on that note, I will hand back to you and hand over to the next speaker.
Afternoon, everyone. Brian, I assume you can hear me?
Oh. Yeah, we're good, JC.
Yeah.
We can hear
Thanks a lot.
Your slides.
We can see the slides,
Right.
yeah.
You can see. All right, welcome or good day, everyone. We're going to touch on something slightly a little bit different. DFM Global, for those of you who don't know, it's actual verb, it's discretionary fund manager. It's privately owned, management owned, and fiercely independent. But today, I just want to quickly discuss the you are here moment, the SA story. Now, first off, proudly South African, love Brian here, love living here, just don't want to have my money here. So there's a big difference, and we'll explain today why that difference exists. We're going to have a quick look at how you truly, really invest globally. It sounds so stupid, and it is simple. To invest globally, you need to take your money offshore. It's simple as that. And many of you don't yet. I'm going to touch on share portfolios and the efficiency of them. We're going to run a model portfolio, which we created, 4 share portfolios. And then we'll do a sort of a practical example of a portfolio construction, because not all of you have the risk profile to invest in shares. So you might have to mix it up with some lower risk assets to combine a portfolio which suits your needs. And naturally that need, how do you define that need? That's exactly why you sit with one of the planners at Brentest and look at it. They call it a F&A or a financial needs analysis. They'll map out your course. They'll map out your route, when your kids will go to varsity, when you need to replace your car, when your cash flow needs will arise. And that we'll look to fit this product into. So where are we? Well, we are on the best AI-driven rally we've seen in years, probably since 2000s.com, where a theme drives the entire market. AI is dragging someone like NVIDIA and its peers, and then obviously the NASDAQ and the S&P and the dollar, etc. Because money keeps on flowing there. So every night when you switch on the news, the talking heads will tell you that the S&P is making new highs. It's new all-time highs. And with the S&P roughly 0.5% off its all-time highs, it's clearly a good time. So the JSE should follow suit because it's a global village. We're all investing equally, right? No. The JSE made an all-time high more than a year ago. We're about 15% off the highs. Not such a great environment for us. So why is that? Well, it's easy. The interest in SA dropping. The relevance, we're becoming irrelevant in a global village, and our variety is dropping constantly. Brian alluded to the number of listings in the JSE, but you can look at the foreign investments, which Brian showed. There's a complete lack of foreign interest. And it's the ANC leadership, let's call it. It's corruption. It's the grey list. It's not a popular list there. Not easy to exit the list unless you do what they ask for. We're bleeding high net worth individuals. We're bleeding taxpayers. At the same time, we are growing social grants at a pace of not. So that can't last. Relevance, we are dwindling in terms of relevance. Our exposure in indices are companies. If your GDP is not growing, your company can't grow, and that company needs to represent itself in an index, it's bound to fall out because it's going to be relatively smaller. And then our trading volumes, due to dropping out of indices, are less and less. So large corporates can't buy our shares, so they just won't. In variety, we've got delistings or companies moving their primary listings offshore, and then obviously a lack of new IPOs, because why would you list in SA? What does it contribute? What would raising capital in SA give to the company? Where would you deploy it? So these are difficult situations to be in. And then, of course, but fortunately, we've got the leadership we do have, and they'll fix it soon. Well, actually not. They can't even get the basics right. Water, electricity, that's shocking. So that's where we find ourselves. Now, again, you need water, electricity, I guess, to have some GDP growth. So let's compare our GDP growth versus our BRICS peers. You've got Brazil, and these guys are in line with world GDP, and let's call it 3% growth in the world. Us being represented by the green and gold, not so much. So you've got India and China looking very good, and even Russia keeping pace with world in 23 and 24. Now, these are IMF estimates, not ours. So mentioning Russia, when you look at Russia, well, let's put a different mix to it. You've got Israel keeping pace with world, Russia even keeping pace with world, Ukraine. I mean, these are countries at war with themselves, one invading the other, trading under massive sanctions, one being invaded by the other one, and we've got, I guess, a good government. So not looking too sharp there. I mentioned losing relevance. So relevance, like I explained, as our companies don't have GDP to work with, their corporate earnings can't grow, and the company share price won't appreciate. Other countries do have growth, and their shares will appreciate due to earnings growth. I mean, imagine if you're selling boxes. Your GDP is not growing. You can't sell more boxes. There's not more to go around. The pie is not growing. And due to the relatively smaller exposure of our shares, you can see our relevance in the emerging market index. 10, 15 years ago, we were 10, 15%. The price obviously is white, but that blue line is the declining relevance. Our exposure in the emerging market index is now barely 2%. Now, the JSE, I mean, when I started using this slide about 3-4 months ago in presentations, I show there it was 1.17 of global market cap. We've now dipped below 1%, the green and gold top left. And the US, obviously, if you bottom, you'll see they were smaller and they're continuously growing. Now, why is this a problem? When you've got smaller market cap, you've got less shares, but you've got a growing number of funds that invest in them. You've got the same guys. No, you've got more guys chasing the same number of shares, smaller shares, less relevant shares, non-growing shares. So you've got about 1,400 unit trusts or ETFs in SA. It's a lot of choice. Like Brian said, they're all picking the same 300 shares on the JSE. You've got 140,000 plus unit trust and ETFs worldwide. If you use Bloomberg just for a quick filter. So it's about 1%. So we as clients invest in 1% of the availability. Isn't it time we consider the other 99% maybe? And then even to make matters worse, this is, like I said, I like Brian here, but these are the facts. The S&P 500 consisting out of 500 shares, if you rank them from big to small, the bottom of the pack, the last 10%. Basically, the JSE's daily turnover is less than the first 467 companies out of the 500. So any of the 467 first companies will trade more turnover per day than the entire JSE combined in dollars. Not a good picture. Looking at, are we safe? Are we low in volatility? Do we have good returns? Well, on the left-hand side, you'll see the arrow pointing upwards. If you've got more returns, you'll be higher up, like the USA or Denmark or Switzerland and Japan. They're all high up. And to the left, that means bottom left, the green is good. Bottom right, red, green, and gold, not so much. If you want to look at the ACWI, I'm going to refer to the ACWI quite often in these charts. The ACWI is the all-country weighted index. That's basically about 4,000 shares in one index. If you say, I want global shares, it's a very good benchmark to use because it basically is a little bit of everything. Now, the green and gold bar at the bottom was so small we couldn't fit the text in there. So I'm using a bit of an additional box for you guys. But we are about a quarter of world index. Now, 1% of funds, less than 1% of market cap, less than a quarter of the world. How much of your money is in SA? Can't be that bad. So let's look at performance. Well, on the left-hand side, in the native currency, in ZAR, or in their own local currencies, we're middle of the pack roughly in this example. Now, I'm moving through these slides quite quickly. They'll be available obviously on the webinar recording afterwards. So go and have a look at them. But effectively using ETFs, iShares ETFs, just to represent some returns for the past 10 years. So we're middle of the pack. We're at least outperforming some like United Kingdom and Germany, etc. But if you convert that to dollar, naturally, we move way lower. And United Kingdom, Germany actually help their positioning. So currency plays a very important part of your returns. So you might think you are returning the JSE to 10%, but the currency might have taken 5 or 10% away. So make sure that you keep track with your global spending power. And this is a very noisy, busy slide, but on the left, it's developed markets. You can see how it's a smarty box. So you can see each country and their performance per annum and where they slot in versus their peers. But on the right-hand side is the emerging market. And again, with the green and gold analogy, we're in the middle of the pack. We never sort of outperforming and we're never really in the bottom of the pack. But in the last 2 years, if this was the green and gold and you were the manager, you'd probably look and have a quick chat with Rasi because that's not a promising trend we see there. And then the slide that we often see Magnus display in social media, you've got past 15 odd years, you've got the S&P delivering a huge amount and the JSE again can't keep pace. And funnily enough, the shaded area is the difference between the two. So if you're a hedge fund, you're long the US and you short SA, you could have made more than looks like 1,000% in the past 15 years. So it's been a horrible period for us. Okay, so that's the bad news. I guess the next step we need to look at where's your money? Where's the client's money at the moment? Naturally, you own a house, that's fixed capital, that's invested in SA. You've got some savings, some cash and investments. That you've got a choice. It's discretionary, it's voluntary. That's money that's in your bank after tax money. And you've got your vehicles and your toys and your beach houses and whatever. If you add that up in your life, it's quite a big footprint in SA. And if you consider you want to have your money similar to what global exposure looks like, 1% of your money should be in SA, 99% should be offshore, for example, it's skewed towards SA. So your risk clearly lies in losing out on spending power or call it dollar strength. So, and the next step, which often gets ignored, is your retirement plan. Now, let's position retirement plan as in force. It's while you're still working, you're still saving, you're still adding to it. You fall under Reg 28, and at Reg 28, you can go and look at it. It basically just says you're not allowed to take more than 45% of your money offshore while in your pension scheme. And then if you change jobs, you might go into a preservation fund, some as a sort of a holding pattern. And then when you're 55 and older, Magnus is very vocal about it. You can take your money and invest it without the Reg 28 compliance restriction. So you can have not 45 max, you can have more than 45. Now, again, the question should be asked, if you are allowed to take 45 and all your house and your toys and everything is based in SA, is your retirement planning process strategy, is it 45%, need a 45, or is it not even close to it? You need to look at that and say, if you've got the ability to do that, you should. Now, I guess the question today is how? How do you create this truly global portfolio? If you look at ways to do it, easy. You need to get your money offshore. You need to invest in, for my example, invest in NVIDIA and Microsoft and Google. So you can do it with two very similar ways. Asset swap. Now, these are just jargon, very easy to explain. Both asset swap and feeder funds. The money goes into a rand denominated door. It goes into a product with asset swap. You'll swap into dollars, for example, and you will buy dollar assets. These dollars aren't yours. You can't use it on a holiday. You can't pay it with a credit card. If you want that money out, it comes back via asset swap and it goes back out the Rand door. Feeder funds, very similar. It'll be a unit trust, for example, with a Rand door. You invest in the unit trust. It's like the CCOM data cable to Europe. It goes underneath the ocean. It goes into a fund offshore. You get the benefit of that investment, but if you ever want to withdraw the money, it comes back via the cable out the Rand door. So clearly the best one is to use Forex. Use your SARS allowance, take it permanently. So your tax allowance, your foreign travel allowance, whatever you can do, you can take it with FX. And I mentioned the word permanently, and I'll explain why. So for my example, we're going to use share portfolios. That's what we do. And why? It's the simplest way to create a truly global portfolio. See it as a platform, see it as a vehicle to do whatever you want to with the instruments you can. So a share portfolio, because it removes so many layers of fees, it's not a product into a platform, into a fund of fund, into a fund, into a business, or a listed entity, which have some real world businesses. This is a share portfolio with dollars, which you buy Google and Microsoft, Nvidia direct on exchange. You are the owner, you are on their share register, you can vote on behalf of the company. This is real time. You can see real time what we buy and sell. And that's normally a concern because clients stress out when they buy something the night and the next morning they see it's down and they want to see why their portfolio is down. It should be for the long run. You are investing in a business and a business should grow. And then of course you say, well, it's a share portfolio, so only shares, I need to diversify. Yes, you need to. And the share portfolios aren't like the old ones. Today, you can buy shares, you can buy ETFs, and on the Saxo DMA platform, you can even buy up to 7,800 other unit trusts as well. That's more than 5 times the amount of unit trusts you can buy in SA only. So you've got the choice. And I keep saying it's cheaper to do it direct. Well, let's have a look at it. You've got the largest ASISA, that's the local category, the largest global equity fund. It's about $2 billion. The returns was about 8.9, and the cost, the total expense ratio, the TR, was 2.1%. So your annual cost of this product would be about 2.1 with a return of 8.9. The largest global ASISA ETF, so we're not using names, just the biggest one. The TR would be roughly about 75 basis points. You can see the lower cost probably directly result in better returns. And the fund is about $1 billion, which is substantial. And then we skip to the largest ETF worldwide. It belongs to Vanguard. The cost is virtually nil, 0.03%, 3 basis points. It's $1.5 trillion, and the return's about 13%. Now, forget about the mandates. You can clearly see lower cost results in better returns. As simple as that. Scale results in better cost. And structures, asset swap, FX swaps, moving money, buying and selling. If you're a smaller fund, it results in friction. It results in performance leaking out of your performance, out of your product. Sorry. So share portfolios, it's not just ETFs, it's not just indices. We've created an actively managed top 25 portfolio. And how do we do that? We again kept it very simple. We as call it multi-managers, DFM, would go and find the most consistent fund managers out there, the best of the best. I mentioned there are 140,000 funds out there available for us to choose from. And if you put in a decent screen, you will come to very good managers. So why not utilize their views, their positioning, and their universe to construct your universe to choose from? So we don't use the hundreds of thousands of options we can invest in. We are investing in a curated, much smaller universe to construct your portfolio. And that inevitably ends up being blue chip shares, big global names, and a decent, well-diversified portfolio with 20 names in it, 25 names in it. The benefits are naturally cost, like I said. It is a multi-manager approach. So if you selected 10 good managers to utilize their universe, it's 10 views, 10 managers, 10 strategies that's being combined into one, and we will do an amalgamated portfolio. And that is truly global because it's invested on exchange. You would be buying on the New York Stock Exchange or the NASDAQ directly. It's not via funds, etc. I keep mentioning the word cost, just to give an example. 15 years worth of savings. You started 15 years ago. You invested $1 million in the sector. The sector is about 128 funds at the moment, and their average cost is about 1.36. So call it 1.4. If you just did exactly the same strategy, use the sector, but just at a lower cost of 1%. Very easy example. Now, I didn't even put the data points there. You made a lot of money in the past 15 years. But investing at a lower cost would have saved you 600,000 Rand. That's 60% of your initial investment saved just in costs. That small difference over time saves a hell of a lot of money. So make sure you not only invest, you need to invest efficiently as well. And share portfolios can assist with that. Now, again, keeping things very simple, like I said, we construct a ground up universe from very good managers identified, use their universe to construct a portfolio from. You do end up with the big brands like I've shown bottom right, NVIDIA, Berkshire Hathaway, Coca-Cola, Google. You know all these names. It doesn't have to be sexy and psychedelic. You can just pick the big boring names. They've got good management, long track record, franchise, big exposure, global exposure. So it's not centralized to the US, etc. Looking at the managers we selected, if you look on the left, we are currently 128 funds in the local category. The managers over the past year, about 30% of them managed to outperform the ACWI, and it drops quite low to over the past 10 years with 2 out of basically 12 funds, 2 out of 28 funds, sorry, outperforming the index. Now, that's not good. So the 8 to 10 managers we select, same track record, same period, 100% outperformance of the index. And the past year, which brings it to a point, let's say 9 out of 10 outperformed the index in the past year. It's a market that's been fueled by NVIDIA and very skewed returns from the AI and tech. So for them to show one underperformance, we're not concerned about it. We're still impressed that everyone still managed to fare well against this. Now, what does the portfolio look like as a result? On the left-hand side, the bright blue line clearly is a big gap. Otherwise, we wouldn't have shown it. But the point to look at is it's actually opening up the gap over time. Now, I mentioned the 1 year underperformance doesn't concern us. And I mentioned the real-time access to your portfolio, which you can see exactly what we do, when we do it, and it will stress you out. Please, when you FX your money and you move it into a global share portfolio and you buy a piece of a business, it's like owning a house. It's a long-term investment. When you need cash flow and you need money, you shouldn't take it from your offshore portion. So that's going to bring me to my next topic of how do you construct an actual portfolio and make sure you've got liquidity? How does it blend? How do you bring down the risk, etc.? But the portfolio has returned very good versus its peers. It's quartile 1, quartile 2. That just means we top half consistently. And we're not surprised because the portfolio has been built ground up using consistent fund managers and their universe. So the results speak for themselves. Now, let's construct a portfolio, but bear in mind, you need to be able to have your offshore money offshore, and you need to have some local money that you can utilize in your daily needs. So real world example, we're going to combine the two. And in my example, it's going to be low risk assets. That's cash and bonds, income fund. And you've got high risk assets, and that's going to be my global share portfolio. So you want to end up with like an income bucket, which your income bucket is your short-term needs, and your growth bucket will be your short share portfolio. Now, again, it's a Goldilocks moment, so we're going to combine it. If yours is 60-40 or 10-90, it doesn't matter. What you want to achieve with your income bucket, and this is where your F&A and your consultation with the Brentis guys would assist greatly, is your needs need to be explained. So if you could perfectly forecast your own future and your plans and your route you want to take with your life and your kids' life and your savings, and you can project that into 5 or 7 years even, and you can have enough money for 5 to 7 years, and say an income fund as an example, local money. You don't have to touch your growth bucket. You can take the balance and move it offshore, invest it for the long term, and not stress about it. If the market sells off, if there's a pullback, if Tony is correct and the market does pull back, you don't have to concern yourself because you've got enough for the next 5 to 7 years. So you're a spectator and you'll be cheering on the market without the stress and the sleepless nights. So how do we combine? Why would we say an income bucket and a growth bucket? Well, the income bucket needs to be assessed. And if you look at the income bucket example, we've taken income in SA, in rands, and we've taken income in dollar terms. The result is the same. The root, very different. The white, the dollar income, you can see sometimes it lags early in the graph. Sometimes it extends above the blue line. But one thing I think we can all agree on is the white line is quite volatile. It's quite jaggedy. It's a healthy heartbeat, or what do you want to call it. So the blue line, however, very, very stable, almost a straight line. So if you want to do planning, you want stability, you want predictability, you want safety in your estimates. You don't want something that goes up and down all day long. You want something that's going to end up where you think it's going to end up. So big predictability benefit in using SA income. At decent yields, it's definitely better than the global alternative. When you look at the equity, it's the inverse. The fat blue line is clearly outperforming the SA alternative. So with these two very simple examples, you want to be investing in SA income, SA cash, have your needs sorted, build in enough of a runway for yourself to take your money offshore and invest it offshore. If you want to change the offshore component, add to it. Don't bring it back. You need to make sure. And I guess that just as important is if you get this correct, and you've got your income, the volatility scale on the bottom, if you get the income to the far left, low risk, and you get your equity right top, you want all the returns you can get offshore in the long run, but you want the safety and low volatility local. You've got that perfect blend of just two instruments which you can use for your planning. But the important bit is to rebalance. I mean, you need to reassess your route. You can't just hit the road and trust you'll end there. You need to reassess it 6 monthly or annually, etc. And that's where we get to the Brentis guys. You'll have your meeting, you'll have your cup of coffee, and you'll say, is the plan I started with still the plan? Have my income gone up? Have I lost my job? Have I changed jobs? Have I bought a fancy red car in my midlife crisis? All these things will affect that route. So you need to rebalance and reassess continuously. And the benefits are clear. You can see it's efficient to invest offshore, and you can see income fund is very predictable if you want to build a portfolio. So in summary, it is simple. It is this simple. Very low in the jargon, very direct, and the Brentis guys can help you. To do a share portfolio, it makes sense. We've all been exposed to the SA failing economy for too long, so our assets probably fell behind the curve where we should be in terms of our growth pattern we wanted. And that's probably as a result due to maybe inadequate advice, maybe they're not informed enough, maybe it's more sinister, they've got some internal targets or products they need to sell, but you need to speak to someone who's informed, skilled, and not scared to voice their opinions. Someone who will actually make the unpopular decision early on in your planning process and put you in the right asset class. So a share portfolio is a non-stop, transparent, and I can't emphasize this more. It's transparent, real time. You get a login, it's on your phone. It's not always good to see what's happening with it, but you can. So if you can take one message from this presentation just home today, is a share portfolio is not just, I want a share portfolio. It's not just for, I've got some cash, I'm going to put it in a share portfolio. It is something you should consider for your retirement planning. So while you're planning, as well as for your post-retirement, the living annuity, etc., like I've shown. So the easiest conclusion to today's presentation is just contact some of the guys at Brentis, have that meeting, do a plan, and see if it works for your financial planning, see if it fits into your portfolio. Thank you very much.
JC, thank you very much. That was great. We're now going to talk about, well, both Tony and, well, good afternoon, ladies and gentlemen. My name is Magnus Heystek, and thanks to Brian and to Tony and to JC to lay the groundwork for what I have to say. But I'm going to deviate slightly from my, and I just want to start with what we have. Not one of our two speakers has used the word the ANC or what the ANC has been doing to this country. And I think before I carry on, I just need to put in context why we are where we are with our recommendations over the last 10 to 12 years to take money offshore. And just a couple of points. My slides are not working at the moment, so I'll have to tell you a story. In 2007, ladies and gentlemen, I happened to attend an international investment conference, And there was a speaker called John Malden, who, and he's a well-known commentator by now. Most people know who he is. And he was talking about technology and technology funds and biotechnology funds. And I went up to him afterwards and said, listen, John, nice talk, but I am from South Africa. I have never heard of biotechnology. Please tell me about it. And we started the conversation, and he sent me a lot of information. And I realized there's something happening in the United States. And this is already 2011, which we were not part of in South Africa. Came back, started looking for avenues to give to our clients and get them into technology, biotechnology funds, global demographics, healthcare funds, the so-called mega trends of the world. And I simply couldn't get them. There was nothing available. But I felt so strongly about and it was showing up in the charts. The charts were showing that the United States was just simply running away in terms of performance. And it was very evident then already that you need to have some of your money in the United States. But the South African asset managers were very comfortable. They were making very good money. They were happy to put you into local stocks only, and a couple of dual-listed stocks. And we had only one technology stock on the market, and that was the Naspers. But that wasn't enough. So a long story short, we at Brentis, we reached out to global investment companies like Templeton, Fidelity, Vanguard, and we said, we want to use your funds. Please put them on a platform that we can use. And we did that. And we got them placed on platforms such as the Momentum Global platform, and also on the, at that stage, the Investec Now 91 platform, Alan Gray, etc., for our clients. We also went to the market. And also at the same time, as Tony Bell said, we looked for a local fund manager to create a local global portfolio for us. And that happened to be the IP Global Opportunity Fund that Tony has been running for more than 10 years. The returns have been phenomenal, almost 16% per annum per year over 10 years. When you compare that to our local funds that have been growing at 4 or 5%, the difference in wealth creation has been enormous, ladies and gentlemen. To give you an example, I did an exercise this morning. Had you invested 1 million rand in Tony's fund 10 years ago, left it there, your value today would be 3.7 million rand. I looked at the Old Mutual Investors Fund, which is the biggest fund at the Old Mutual company. Your value today would be 1.3 million rand. So you can see the difference in returns to our clients over time. So initially, our recommendation to take money offshore was based on pure financial statistics. But USA was in a boom phase, and we said take some money offshore. And we said so very explicitly on media and radio, which made us very unpopular in the local investment community. They said we were talking rubbish, and they criticized us, and some of the comments on social media were downright horrible. But we stuck to it because we could not make a stronger case for the South African market. And then, of course, we had politics. We had the Zuma years, we had the state capture years, we had the down ratings, we had the collapse of Eskom, the collapse of Transnet, and the wholesale looting and theft by the ANC government in all spheres of government, from top to bottom, from municipal level to provincial level, government level. And of course, crime just went through the roof. And one of the things I've learned in the investment world over many years is that when you're looking for countries to invest in, law and order, and secondly, property rights protection are the two biggest issues that you look at. And on those two criteria alone, South Africa does not qualify and has not qualified for 10 years. So lo and behold, 10 years later, now the asset management companies are saying, oh, well, we've had a lost decade, and now you must invest in dollars. And on my phone, and I'm quite sure on your phone, in your Facebook, there's almost daily an advert from Alan Gray or Coronation or 91 or Stanley about offshore investings. And I'm saying it's 10 years too late, and you should hang your heads in shame that you waited so long, and you've actually damaged the wealth of many, many people in South Africa, in my view. So that's where we are now, ladies and gentlemen. As Brian has alluded to, Coronation at the AGM 3 weeks ago admitted no dollar return over the last 10 years. Alan Gray, almost in the same week, said it's 15 years of no return in dollars. Now, why is that important to you as an investor? As JC has pointed out, you've got your other assets are all priced in rands, your house, your maybe a second house, or your business, your farm, your pension money, mostly priced in rands and has been growing in rands, or some areas not. Property has been a terrible investment for 15 years. So that portion of your portfolio has shown no growth in dollar terms or in rand terms for that matter. Your pension money, if you look at your pension returns the last 10 years, is averaging between 6 and 7%. And with inflation at 6 minus costs, you've made no money in your pension funds. But many people don't realize this or understand this, but they do realize it when they jump on a plane and they fly to London or Washington or wherever, Australia, to go on tour, and they have to pay 1,000 rand for a steak or 200 rand for a beer, and then they complain that those cities are so expensive. The truth of the matter, ladies and gentlemen, is we have become extremely poor in 10 years. Middle-class wealth has been wiped out as a result of the ANC policies, and also with the assistance of the local asset management industry, in my view, which have tried very hard to suppress how bad the local market has been doing. And I have personal experience. I've been criticized in the press. The Business Day called me Dr. Doom for advising people to invest offshore, and the list goes on. But the fact is, and it's something that I stress at all my talks, all my seminars, etc., I don't work, or Brenters does not work for the large asset managers. They work for their clients. And that is the only grouping of people that we are concerned about what they say. And they are extremely happy that we had the guts, the courage, or the foresight to externalize a lot of assets when it was not popular. And there are many people listening to this who are our clients, who can testify to the fact that we have built and protected their dollar assets as best we can. And I'll give you one example. It's a prime example. It's like a school teacher who's got a lot of good students, but he's got a prize student and always brags about the one student. I'll give you an example of one client who 10 years ago came to us and had a large amount of money to invest, 15 million rand 10 years ago. And we advised him to take the money offshore, and we gave our reasons, and it took him a while to believe us and invest the money. Well, that was 10 years ago. That money today, ladies and gentlemen, and the 10-year period is up in 2 months, is today worth 115 million rand. In other words, out of that 15 million rand, we have managed to create wealth for him and his family of another 100 million rand. And that would have not been possible in the South African market. I did a back check with the South African market. Had we not taken that money offshore, the best return I could find, going back with the assistance of hindsight and chosen the best fund in South Africa, that 15 million rand would have only grown to 43 million rand. So we're talking about substantial wealth creation on behalf of our clients. But why are we are now? We were up against vested interests. Asset managers, banks, and even property developers had and still do have a vested interest in not telling the true story, in my view, about the South African situation. The South African economy has been flatlining for 10 years. It's been badly mismanaged. Yet we have these so-called sunshine economists who come around and they're forever talking up the market. And I'll give you an example. And I'm coming back to Old Mutual again. In March 2019, 5 years ago, And it was on the front pages of newspapers, it was on television programs, it was on radio talk shows. Old Mutual went around saying the South African stock market, i.e. the JSE, will be the best market going forward over the next 5 years. Well, obviously, I kept that article and I still have it, and I've written about it extensively. Today, the performance of the JSE and specifically the Old Mutual funds have been the worst in the world. The average return of the Old Mutual growth funds has been 4%, which has been less than the inflation rate. So it made no money. And you compare it to a fund like Tony's that's been doing 16%, you can see what damage the sunshine economists and almost a concerted effort to lie to the investing public in South Africa about the state of affairs. But let me finish off by summarizing. And JC has dealt with it, Tony, and how do you do it? How do you actually do it? And you can do it with small amounts of money. You can do it with a debit order. You can do it with large amounts of money. You can take out 1 million rand per annum and externalize your individual investment allowance. You don't have to take 1 million. You can take 100,000 or 500. And you can create an investment portfolio which is unlinked or unattached to what's happening in South Africa. It is offshore. You're investing in dollars. You might be immigrating in the future, which is a trend in our society one cannot ignore anymore. So for another reason why we're very unpopular, and I'm unpopular with the asset managers, I am not a strong I'm not a strong believer of putting money into retirement annuities, for instance, because it creates a problem if you want to retire one day. So coming back to how do you do it? You can do it with small amounts of money, but if you're going to invest larger amounts of money, it makes sense to make an appointment with one of our advisors. We've got 24 in the stable, countrywide. Don't sit down and talk to one of our advisors. We're going to give you advice. We're not going to try and sell you anything. We have nothing to sell. We're not an asset manager. We are under a fiduciary duty to give you the best possible advice. The advice now, ladies and gentlemen, still remains externalize as much of your discretionary money as you can. Now, secondly, for investors older than 55 who have money locked up in retirement preservation funds, retirement annuity funds, preservation provident funds, there's a lot of money. It is my very strong recommendation that you pull that money out, despite what the fund managers keep on saying. Externalize what you can and get your money out of the control of the large asset management companies. We have already, the ANC have made it very clear that after the election, they will introduce prescribed assets. And a lot of people don't fully understand what that means. But what that means is the government will force asset managers to invest a portion, and how much we don't know, could be 20, could be 25% of that money in the fund into prescribed assets, in the sense that they will be forced to invest in Eskom, Transnet, waterways, roadworks, or whatever the case might be, where we have seen the value destruction over the last 10 years. So now government wants your money to rescue those state-owned enterprises, and it will have an effect on the eventual return. So do not believe stories that it's not a big factor or it's going to be okay. It's not going to be okay. So ladies and gentlemen, on that note, if you want to write to Brenthurst Wealth and get an appointment with one of our advisors, just send us an email to invest@brenthurstwealth.co.za. That goes to a central data box and we will spread it out. Or simply have a look at our website and make an appointment. Or lastly, if you don't want to do business with Brenthurst, that's fine, but go and see another advisor. But my advice is get some money offshore. You will thank me one day. Brian, that's all from me.
Thank you, Magnus. Thank you, Tony, and to JC. I think that encapsulates pretty much our strategy that's been around for a long time. As I said, we've been doing this for more than a decade, and it certainly has yielded some results, or very good results for our clients when compared to the local market. We have one or two questions that have come through. One of them is actually a similar question about citrus tax, in terms of what about citrus tax relating particularly to the share portfolios, and that is a concern. But there is a solution to that, and what we've been suggesting for clients who are considering investing into a share portfolio is to invest it into an endowment structure, which is a South African tax structure in terms of the 5-fund approach. So the actual institution or the life assurer will pay the tax on behalf of the investor to SARS, and that then excludes any shares in that particular share portfolio for citrus tax. So that's the solution that we've proposed to all clients looking at building a share portfolio. There was another question with regards to when investing offshore, does it matter to use a South African company, Sanlam or Old Mutual Global Life Products, or should you invest offshore with an offshore company rather? Is there a risk that regulators eventually come after externalized assets when done through South African companies? You know, this is a question that we don't know the answer to. Certainly, obviously, the increase in terms of offshore allowance, having increased from, I think it started at about 250,000 Rand at the time, now currently 10 million with your tax clearance and 1 million with your SDA or single discretionary allowance. Once that money's offshore, one hopes that there is no reach, but you know, one doesn't know how that could potentially change, depending on who's you know, in power in terms of able to change the laws. So whether you're with a local product provider or an offshore product provider, I don't think that would really matter. It really is what is the regulation in terms of exchange controls and or a change to the laws in that respect. There was a question in terms of, let's just have a look here. JC and Tony, maybe I can bring you in as well, just in terms of from an offshore perspective and your views at the moment in terms of where do you see the opportunities from an offshore perspective? Obviously, externalizing your assets is one thing, but where do you see the opportunities, knowing, of course, that we saw quite a huge increase in the US market in particular? Are you still favoring the US? Are there other geographies that you're looking at? Maybe you can just give us some of your feedback on that, and then we'll start with Tony and then go to JC.
Thanks, Brian. I think the sort of core to the question is capital formation. One of the points that Magnus makes about the performance of the JSE is really embedded in South Africa. Does not have a growth problem at all. It's got a capital allocation problem. Until capital is reallocated and you have some sort of incentivization by private enterprise to commit risk capital, South Africa's growth profile won't change. And it's in that context that you've got to look globally. So we see very rich capital formation in the States. Outside of the Nifty 5 or the sort of Magnificent 7 at the moment, there's a lot of investment taking place in the restructuring of the US economy. We've had the Infrastructural Development Act, we've had the Inflation Reduction Act, and indeed the CHIPS Act. And if you look at companies like Caterpillar, they've done equally well. They're just really not in the limelight. And we also see in Japan, where we've got good exposure in the global IP opportunity, we see a long period where Japanese companies have restructured their balance sheets, restructured their operating models, and they're in fact doing very well. And hence we've got a nice exposure in Japan as well. I think Asia is a little bit more difficult. The political overlays in China make it more complex. The instruments through which we can invest are a little bit more opaque. We don't quite like the structures through the Bahamas, etc. So we look at it on terms of security of capital and the way in which the geopolitical environment supports new capital formation. And that was factor number 7 on our 7-factor model, where companies can continue to generate organic growth purely because the environment is there for new capital formation. And that, Brian, holds the key to where you go with your capital offshore.
Brian,
for
if I
that,
can
Tony.
just add, Brian, can you hear me?
Yeah, I can hear you.
Another example of the local bias, if you read the local press and then listen to the local media, I have yet to see or hear anybody of the last couple of years to discuss Japan, for instance. And I was fortunate enough to be in Japan about 5-6 years ago. We had lectures on Japan. We met at the Japanese Central Bank, etc. And we came back, well, I came back and I said, we need to have some exposure to Japan for our clients because I liked very much what was happening. And it's not well known that the returns on the Japanese stock market the last 5 years, and especially the last 2 years, have almost matched and beaten the S&P 500. So that's just another example of the home bias of investments, and you should try and break that mold. We live in a globalized world. Our dollar inflation is very important. We travel, we buy overseas computers, cell phones. We might live offshore one day, and we will end up very poor if we keep on investing in rands, and one day you have to pay in dollars. And we already see it in the last 10 years, how due to the fact that local property prices and the rand has weakened so much, fewer and fewer people can afford to actually immigrate to a place like Mauritius or the UK or Australia to immigrate because they're simply too poor. They don't have enough capital. In South Africa, they might be considered wealthy, but in a global term, they're not wealthy and they cannot afford to buy a 2 or a 3 bedroom flat in Mauritius, which costs the same or even more than a very large house on a golf estate in South Africa. So that's just another example. So I'm glad Tony mentioned Japan. Another country is India, doing very well. And then there was a question that I think I want to answer before I say goodbye. Someone was asking about trusts. Now, we have in the last year or so bought a trust company in Mauritius for exactly that reason. We have externalized a substantial amount of money for our clients into other parts of the world. And we feel strongly that investors should consider placing those funds into a trust, which has been managed by South Africans or South African companies, for the simple reason that, and that's not me saying that, David Butchart, for instance, the well-known columnist in Politics Web last week, said he suggests or he thinks that exchange control will be reintroduced one of these days when the ANC runs out of money. And one way of protecting your capital against that from happening is to put it into a trust. We effectively, it's not yours anymore. It's managed by professional trustees, managed by Brentus from its Mauritian operations. But it's another level of protection against the predatory policies of the ANC. So I just thought I need to make that point with so many people listening today.
Thank you, Magnus. JC, I don't know if you wanted to sort of give your views on that as well in terms of where you are investing at the moment.
Yeah, being global share portfolios, I'll try and sort of stick to what you can buy and sell on exchange. I think when you look at allocation, and Tony explains the mechanism behind it, and I think so if I go a little bit more micro in terms of what sectors you see move, I mean, you alluded to the Magnificent Seven, which Tesla fell out of the bus, or out of the EV car. It's changing all the time, but the market was driven by AI and the Magnificent Seven. So naturally, they would be extended at the moment. And like Tony, we've taken profits in those areas. I think if you go outside all the stats showing, 90% of the year's returns have been driven by the Mag 7, that just means the other shares have not really contributed. They've gone sideways or negative, and with earnings growing in a quality company, those companies are now cheaper. So even though portions of the market might be expensive, we would use the opportunity to, like Tony went from 7% NVIDIA to say 5% NVIDIA. We would take that 2 percentage points and reallocate it to, for example, healthcare or foods and staples, stuff that people would need every day. So they'll still go to the shop in our local terms, they'll still go to ShopRite, they'll still 60/60. That doesn't go away.
but the discretionary spending on risk budget, buying NVIDIA and those kind of things might rotate into these. And I think another theme which scares me a bit is the commercial real estate. So even going offshore and sticking it into real estate, it could be a minefield as well. So be careful in terms of where you allocate money. But I think in general, I think my message would be is at the moment, we would be a little bit more defensive, have a little bit more certainty built into the portfolio and steer clear from the relatively obvious mines. And we also agree in our global balance, we're also sort of tilting towards Japan, and we're also tilting selectively, we'll take native currency exposure as opposed to dollar exposure as well. Because we think some of these countries might actually outperform the dollar. So it's not an easy answer. And I think, Brian, sorry, I just saw a question on the part of the questions they asked, what's the minimum amount or what's a practical amount for a share portfolio? I'll just quickly address that as well. We typically put it's due to exchange fees of buying and selling. It's fairly costly for small numbers. So we say if there's 25 shares in it, roughly $2,000 per share, about $50,000 should be your sort of mental minimum allocation. That should work. But if you're not an active investor buying and selling shares all the time, that cost is once off and you buy and hold, it's irrelevant going forward. So the portfolio doesn't have to be $1 million and more, but it's optimal from then upwards.
Thanks, JC. We've got time for one or two more questions. And one that's popped up here is, does Barenthurst assist with SARS application for taking the max rands overseas? We do indeed. We've got a Forex department who is able to assist with those tax clearance certificates. Has become a little bit more onerous, but our ladies are able to assist with that. And we're also able to do the Forex transfer offshore directly in-house for any clients that are looking at getting some money offshore through the tax clearance facility. And then there was one question just with regards to the available capacity, offshore capacity for living annuities. And that has come under a little bit of pressure depending on which product provider you're looking at, but most of them are at 45% max that they are allowed to take offshore, but there are one or two that allow much higher exposure. I think Momentum allows almost 100%, and then Sanlam Glacier is the other platform that allows a much higher capacity in terms of the offshore allocation. Ladies and gentlemen, I think that's all the time that we have this afternoon. We want to thank you for your time, and if you are going away over the public holiday, please enjoy that, travel safely, and chat to you soon.